Hello, my name is Elliot Gu, and I'm co-founder and chief market strategist for the Pig vs. Bear trading product. Over the past 18 months, I've had the pleasure of regularly speaking to a London-based trader and portfolio manager about stocks, the broader market, and the economy. He has extensive experience in fixed income portfolio management for one of the largest and most recognized bond management companies in the world, and offers a truly unique perspective that's been invaluable in talking through trade ideas, investment ideas for our services, and of course our broader outlook for the markets and economy. Now, just last week we had a lengthy conversation about a stock I regard as one of the most dangerous large cap companies in the United States. It's about a $50 billion company. It's a name that just started to break lower, and I think a more serious collapse is imminent. Listen, he's asked to remain anonymous, but he has agreed to allow me to release our recorded conversation about this stock today as part of this free video. However, I must warn you, the call I'm about to make is very controversial. I'm pretty sure I'm going to receive some hate mail about this, for the simple reason that every time I read about this stock, I've received some negative feedback. And there are plenty of people who still regard this company's CEO as a sort of modern-day 21st century folk hero. However, the bear case for this stock is just too compelling to hide behind a paywall. The situation is just too dire and too dangerous for me to ignore the risks and, even more importantly, the potential opportunities associated with trading this stock on the downside. Simply put, I believe this company, with a current market cap, as I said, of $49.3 billion, will either file for bankruptcy or be gobbled up by a larger competitor within the next 12 to 24 months, perhaps much sooner. You see, I've been tracking the dangerous fundamental issues facing this company quarter by quarter and press release by press release for more than 3 years now. But my research suggests the situation has moved from just troubling to outright dire. And given the extreme valuations for this stock right now, despite mounting losses and negative free cash flow, I believe it will be among the first to crack as the broader market approaches the end of the current bull market. So you've been warned. If you have a thin skin when it comes to controversial stocks, you might just want to click away right now. However, I urge you to keep listening to this presentation through to the end to hear me discuss the bear case for this company with our London-based guest contributor.
Hello everyone and welcome. My name is Elliot Gu. I'm the editor and co-founder of Deep Dive Investing. And today we have a very special guest on the line. He is a London-based or brand new London-based contributor to Deep Dive Investing. And I'd like to introduce him today. Welcome.
Hello. Very happy to be here.
Well, it's great to have you. Great to have you on the line. And just so everyone knows, you have an extensive background in the fixed income markets, in particular portfolio management of bond portfolios and fixed income portfolios. And so that's a very unique perspective that you bring to Deep Dive Investing. But I want to start out by talking about, and we speak pretty frequently about the markets and individual stocks and sectors. In fact, we just had a conference call just last week for a couple hours talking about our outlook for the markets, the economy, and various stocks and sectors. And I thought that it would be really useful to bring your perspective and some of our discussion to Deep Dive readers this week. And I wanted to start out by talking a little bit about a stock that we've been talking about a lot from the bear perspective, a stock that we think is very challenged right now, and that's electric vehicle manufacturer Tesla, symbol of course TSLA. As Deep Dive readers know, we've talked and written a lot extensively about the car market here in the United States and the fact that there's a humongous number of cars coming off lease over the next few years, around 4 million vehicles this year, 4.5 million vehicles in 2019, and as much as 5 million vehicles coming off lease in the United States in 2020. We're already seeing the impact on used car prices. We're already seeing the impact on now the new car market in terms of slowing sales since last year. And we've talked about a few different ways of playing that downside, both from a long-term perspective in Deep Dive Investing, as well as in our shorter-term trading service, Pig vs. Bear. But today I wanted to talk a little bit about Tesla specifically and some of the specific challenges we see going on in Tesla. So why don't we start out by just sort of framing maybe the bear case for the stock itself.
Sure. I think from my perspective, the case was, always when to short Tesla as opposed to whether to short Tesla. We're talking about a business that's never earned a single dollar in net income, never earned a single dollar in terms of free cash flow, has to borrow to service its debt. There's no question of them being able to repay debt unless they're able to refinance it. We're talking about supposedly a tech company that has the lowest R&D budget of any of its major competitors. In fact, the lowest multiple of them being outspent in terms of R&D that I was able to find was a factor of 5. So they're spending roughly 1.5 billion. GM is spending 7.5, BMW 8.6 billion, Daimler Benz 7.25. So, like I said, this is a tech company that's unlikely to prevail in a rapidly changing technological field. It's never been able to make any money. I doubt that they will ever be able to make money. So for me, it was always a question of when and not if. And the reason why finally I came around to the view that now is the time is that there has been a sequence of events that, to my mind, represent a significant turnaround in the sentiment, both internally within Tesla, but also in the market. So a few things that have been happening. Between February and March, Tesla lost its sales and service chief. It's lost its chief accounting officer, who also was the corporate controller. And they also lost the head of the vice president for finance. And this is at the end of a long list of executives, roughly 18 people having departed the company within the last 18 months. So we're talking literally about a stampede of insiders on their way out. The subscribers will have heard of the accident that happened in a California highway on March 23rd, which flagged a lot of problems with Tesla's autopilot. This has been a key selling point for the company, that it's going to lead the way in terms of autonomous driving. Now, I mentioned the numbers in terms of total R&D budgets, and part of that obviously goes to autonomous driving. But right now, Tesla doesn't have any kind of lead in this area. In fact, they're tied with GM. I think there's 4 different grades, all the way up from 0 autonomy to 4. And right now, Tesla is tied at 2 with GM. Volkswagen is an example of a major established car manufacturer who's already at 3. Google and their own offering is at 3. So they don't have a lead, and they probably don't have the budget to be a lead. This accident brought this thing to the forefront of investors' perceptions. Another key point has been the Theranos case, with which some of your subscribers may be familiar with. What happened was that in March 2018, the SEC brought charges which were subsequently settled against the CEO of Theranos. Now, Theranos was a pioneering, technologically pioneering medical tests, blood tests company, and the charges were alleging that Theranos CEO had actually misled investors, and she had argued that it wasn't misleading investors. She was just making statements of an uncertain nature, considering that we were talking about cutting-edge technology, but she settled. So that's created a precedent whereby the SEC and a defendant have actually agreed that it's possible to make misleading statements even in the context of cutting-edge technology. Now, the reason why there's important read across for Tesla in this regard is that Mr. Musk, the Tesla's CEO, has been making a lot of such forward statements, which now are at risk of being considered misleading and forming the basis of charges being filed against him. So he needs to be a lot more careful about what he says about the stock. It's not as easy for him to prop up the stock, the price of the stock, the way he has been so far.
I mean, case in point this week, right? I mean, we've had, just this last week, we've had Elon Musk come out, talk up Tesla stock on several occasions. We had him come out, I believe it was this week, with a forecast that by 2020 they were going to be producing, 1 million of their new Model Y SUV by 2020. And they can't even meet production targets on the Model 3, which they supposedly started producing last summer, right? So this is Musk has a long history. Elon Musk has a long history of being out there trying to talk up the stock, and doing so, making sort of fantastic claims that don't seem to have any basis in reality, or at least not any basis in hard numbers.
Yeah, just to give some more color in terms of the production misses for the Model 3, which was going to be the mass market car that was finally going to deliver economies of scale, on the back of which Tesla would finally start earning a profit and positive free cash flow. Now, the target was for Tesla to produce 5,000 of these cars per week at the end of 2017. Then at the end of the first quarter of this year, Mr. Musk celebrated the fact that they were able to produce in the last week of the quarter 2,000 cars. And that was on the back of a revised target of 2,500 cars per week. So he missed that as well. He tried to frame it as a huge success. And now the target that he had set for the last quarter of 2017 has become the target for the end of June. So he's saying that Tesla is going to be able to produce 5,000 cars per week by the end of this quarter. Now, the history of Mr. Musk, especially in this regard, is that he overpromises and underdelivers. There's absolutely no reason in terms of his credibility to think that he's going to be able to deliver on this target. They've already had a stoppage. He's already announced that another previous supposed competitive advantage of Tesla, which was the complete automation of car manufacturing, something that companies with literally more than a century of experience in the field had not been able to pull off. He was in fact making fun of all these other incumbents for not being able to do it. Spectacular turnaround. He's now not going to be going for that full automation. He's going to be hiring 400 people a week. Who's going to train them so that they deliver at the breakneck pace that he has promised is a different question. What that's going to do for margins is another question. And all this pressure, the departure of the key executives, the fact that he can now only make implicit statements about all these things. This is not market guidance that he's giving anymore. He tweets, he leaks internal memos in order to prop up the share price, because any kind of formal statement can actually be used to indict him on charges along the lines that we discussed. Is that there are signs that he is, increasing signs that he's gone completely unhinged. I mean, in March, just as the company was missing its production targets, he was photographed burning absinthe, glasses of absinthe in Israel. A few weeks later, he's sleeping on the factory floor and tweeting that auto manufacturing is hell. Who could have known, right? There's his tweets are displaying a new mentality of everyone is against him. He complained about the economist. He said it used to be boring, but at least it was witty. Now it's just boring. Why is it boring now? Why was it witty but boring in the past? Well, in February they had an article, The Rise of Mr. Musk. In April they had an article about Tesla's woes. So before they were at least witty, now they're boring. It all seems to depend on how favorable his personal coverage and that of Tesla is, and that then defines the quality of the news magazine. Like I was saying earlier, he's been reduced to defending Tesla via Twitter and leaked internal memos. The latest one was this week, where he's basically ranting about suppliers whose offering is not up to scratch. Of course, he's not really paying them. He's not really going for top materials because he doesn't have the cash to do it, but it's their fault for delivering material that then needs to be reworked. Then he's complaining about how people at Tesla are wasting time in meetings, and they should feel free to walk out of any kind of meeting where they don't feel that they're adding value or being helped during those meetings. He's complaining about the fact that the costs have been running too high, and he's personally going to sign off on anything that's worth more than $1 million, either in terms of accrued expense over a 12-month period or $1 million or more single-ticket items. How he's going to do it when he's lost his chief of finance, his chief accounting officer, and corporate controller, I don't know. He's taken charge of manufacturing. He's taken charge of finance. He's taken charge literally of everything. I don't know how he's going to do it. I very much doubt that he can. And every single thing that comes out of his mouth or his Twitter account suggests that he's completely rocked and overwhelmed by this situation. So all these factors combined are sufficient signs for me that what was previously an obvious short is now a short that is actionable in the market. And I think that the call to take a position that benefits from Tesla's share price declining was very, very timely when it happened on this service.
Well, absolutely, and I think that one of the things that I've always thought about Tesla is that, I mean, a stock, the company is essentially a confidence game. As long as he can keep the stock price high, he can issue more shares when he needs cash to fund this sort of black hole of free cash flow that they've had over the last several years. They haven't made a dime. They're burning through cash at sort of nosebleed pace, and the only asset that Tesla seems to have is the stock price. Wouldn't you say that's pretty much right?
I couldn't agree with you more. That's the only asset that they have right now, which is why Mr. Musk has been so defensive of the company's reputation and of its share price. Because right now, with the bonds that were recently downgraded deeper into junk territory by Moody's, it's impossible for him to raise more debt. I mean, I read some stories on other other services about how they can borrow against the Gigafactory, how they can borrow against their intellectual property, and it makes me laugh because no one is going to lend them money, collateralized or not, simply because the company is already very highly levered, because the numbers for the company itself don't make sense in terms of how much any additional debt capital would cost. So the only thing that they have going for them right now is maintaining a high valuation. Speaking of which, Tesla currently trading at $50 billion against GM's $54. GM is generating $7.6 billion of annual profit compared to minus $2 billion for Tesla. BMW just 50% higher valuation at $75 billion against a net income of $10 billion. Daimler-Benz $87 billion in market cap against $10.5 billion of net profit. $13 billion in net profit. It's 10.5 billion euros. So, I mean, the valuation is ludicrous, but that's the asset, right? They can issue shares against that. And as long as the share price is high enough, as long as the market cap is high enough, the dilution is not going to be too great. And perhaps the dilutive effect of any new issuance will be trumped by the new confidence that this will breed in the company, because it will postpone any kind of cash crunch that they will otherwise face, as they surely will by the end of the year. They face lots of maturities of debt early next year. They have a convertible that's out of the money. I believe that's maturing in February. It's roughly $1 billion that they cannot spare. So the share price is definitely the only thing that they've got going for themselves, and they need to defend it. And as it goes down, the bear case for Tesla actually becomes stronger, not weaker, even as the valuation goes down, exactly because the valuation itself is the asset.
Right. I mean, and if you think back, I was looking at just the other day. It was about 3 years ago in May of 2015 when Elon Musk first said that he didn't think they were going to have to go back to the capital markets for more capital. They weren't going to have to issue more shares or take on additional debt to fund their operations. And I believe he's actually done 5 or 6, capital raises since that time. So, when he came out earlier this week and said that he thinks that Tesla's not going to need to issue shares to raise more capital, it becomes a little tough to believe it when he's made that same claim, 4 or 5 times and basically never followed through on it. So I do think when you see one of these rallies in the stock, which you tend to get when Musk tweets something or comes out with some sort of a statement, that's probably a really good opportunity to load up on this trade if you haven't already gotten in for the eventual downside there. And I wanted to move on from the basic bear case for Tesla and into how we've chosen to make this trade, because one of the things is that about almost a quarter of Tesla's outstanding shares are already sold short. Most brokers will not allow you to borrow the stock to execute a short. And even if you can borrow it, my understanding is that it's pretty expensive. It's pretty expensive to borrow, and I'm sure you've heard the same thing.
Yeah.
So we've chosen to go through a different trade, which is a bear put spread or a bear debit spread. And so why don't we just sort of walk the listeners through that process, exactly why we're doing the trade that way rather than buying a put outright or shorting the stock, and have a look at the actual mechanics of the trade itself, the vehicle we've chosen, rather than the theory behind the short.
Sure. As we just said, because the share price and the valuation are the most significant asset that the company has right now, and because they defend it so vociferously, it feels dangerous to go short outright. And the reason is that, in order to short outright, you mentioned some of the specific difficulties that you'd face if you wanted to short Tesla, but generally speaking, you need to fund the position. You need to post collateral. And as the position moves against you, you need to top that up. So that means that ultimately you have a position where you don't have a defined principle for it. The market determines how much more money you need to throw in. And this can stop you out. It can become difficult as a position to maintain psychologically. It feels that you're throwing good money after bad. It's a dangerous game to be playing, and unless there's some serious momentum behind declining prices, it can be nerve-wracking and cash-burning, to be sure. So buying a put protects you against all these things. It's not a foolproof method for a number of reasons that I will list, but at least it has a defined principle that you commit to the strategy. You cannot lose more money than you put up when you buy the put. So it feels a little bit safer if you size the position appropriately to your portfolio. Then you know what your maximum loss is going to be, and you can sleep much easier than night than having an open outright short on the stock. Of course, there's a downside. What is the downside? The downside is that put options, by definition, by construction, have an expiry date. If you're not in the money by the time that the puts expire, then you lose 100% of the premium that you paid for it. The second one is that, especially for a stock like Tesla that has a very high realized volatility, the puts are priced accordingly. The implied volatility is 30-40%, so you're paying up for the privilege of owning a put. It's not a stock where many real money accounts, actual market participants, investors, if you will, are looking to sell puts on. So as a result of that, usually you're buying a put from a market maker who needs to hedge that position. That means that increasingly, if they need to start a short position on the stock themselves, which we explained is difficult to do and costly, so they will charge you for that. So buying a single put may prove to be on the pricier side of what we like to do. So a way to mitigate to mitigate that, to put a lid on costs, is to buy a put at a higher price and then sell a put at a lower price.
So there you have it. And let me just run through a few quick facts about Tesla. The company is losing money and burning through cash at a tremendous pace. Nearly $3.5 billion in negative free cash flow last year alone. Tesla already has more than $8 billion in debt and a debt-to-equity ratio of an incredible 241.1%. The company has consistently missed its production targets for the Model 3 so-called mass market car. The read-through from the SEC's case against Theranos suggests Tesla's CEO, Elon Musk, may not be able to make aggressive, unsubstantiated claims about the firm's business prospects with impunity anymore. 18 members of the senior management team have departed the company over just the last year and a half. Now, Tesla spent less than $1.5 billion on research and development in 2017, compared to around $8 billion for GM and $8 billion for Ford and even more for Daimler Chrysler. Tesla does not have leadership in autonomous cars, despite what you may have read. Actually, Google, Volkswagen, and others are well ahead of Tesla on the technology front. Tesla owes its suppliers nearly $2.4 billion in unpaid accounts payable. In fact, Tesla's only asset is its overvalued stock price. Once the stock collapses, as it started to do, there's no way for the company to raise the capital it needs to stay in business, even for a few more quarters. And to top it all off, Tesla faces a fast weakening car market here in the US and falling used car prices. Add that all up and you have a compelling case for trading the downside in Tesla shares. And we think the break lower is absolutely imminent. Listen, it's not really practical to short Tesla right now, but in Pig versus Bear, we've devised a strategy using put options on the stock to play the downside in Tesla with limited risk and quite a bit of upside. That means you'll want to jump into this trade right now before the stock really collapses. The best part of all is that you can gain immediate access to our bear trade in Tesla and all our research on the stock with a risk-free trial membership to Pig versus Bear at the lowest price we've ever offered for this service. This special opportunity is only open for a few days and only to a strictly limited number of new Pig versus Bear trial members. And it's only available by clicking the button below this video before it's too late. Click the button below this video to read my open letter on the current state of the stock market, a few more details about our recommended trade in Tesla, and some of the other trades we're making in Pig versus Bear right now. Here's to your wealth.